My name is Mark Trapp. I'm with Conn Maciel Carey, and I work out of our Chicago office. I handle a lot of labor and employment issues and deal quite a bit with multi-employer pension plan withdrawal liability, which I'm going to launch into. Today, our agenda will entail three different aspects of withdrawal liability: avoiding withdrawal liability, minimizing it, and fighting it. First, let's talk a little bit about business planning to avoid withdrawal liability. Withdrawal liability was created in 1980. It's a part of ERISA. The Multi-Employer Pension Plan Amendments Act, which you see there on the screen is the MPPAA, is what created withdrawal liability. It's basically an exit fee that is charged to employers that cease having an obligation to contribute to multi-employer pension plans. It's calculated by calculating a sum known as the unfunded vested benefits, which are basically the delta between the vested benefits, which is a basic concept under ERISA, the vested benefits that are promised to participants in a multi-employer pension plan that will come due at some point in the future. Those have a set value in the future, and the unfunded vested benefits is the portion of those vested benefits that is unfunded. As those of you on the call may know, many multi-employer pension plans have been severely underfunded in recent years. We'll talk towards the end of the presentation about the American Rescue Plan and how that has provided funding, but how it may not be to your benefit, just to the pension participants. But the unfunded vested benefits are calculated by that delta, and then they're adjusted several ways to reach your actual withdrawal liability. Withdrawal liability is triggered by a reduction in the number of contributions or a cessation of the obligation to contribute. It happens through various ways, through a sale, closure. You can shut down a plant or a facility. You can have layoffs. The union could decertify. The fund could expel you. You might bargain out with your union. And note this, the mere failure to make contributions that are due under a collective bargaining agreement does not trigger a withdrawal. It's not based on the actual fact of whether or not you make contributions. It's whether or not you're legally obligated to make those contributions. Let's look at a complete withdrawal. A complete withdrawal occurs when the employer permanently ceases to have an obligation to contribute under the plan or ceases all covered operations under the plan. It can, like I said, it could result various ways that I've listed there. It's driven by the legal obligation, not by the mere fact that contributions may have ceased. And I want to talk a little bit about the expulsion here that some funds call adverse selection. You might have an agreement to contribute, or you might try to get out of an ongoing obligation by saying, well, we'll contribute for these senior employees or the people that already have benefits under the fund. We'll grandfather them in, but we're not going to contribute for new employees. That generally means that the folks that are most likely to receive the benefit are the ones for whom the contributions are made, and plans often refer to that as adverse selection. And their business model requires contributions for many people who will never get benefits. That's the dirty little secret underlying adverse selection, but there it is. And so many of them have rules that will not permit arrangements like that. So they might expel you if you enter into an agreement like that, triggering the withdrawal right away. A partial withdrawal occurs when there's a 70% contribution decline over a 3-year period. There's two different ways that occurs. The first point there under the 70% is a cessation of obligation to contribute under one, but not all CBAs. So you may have more than one collective bargaining agreement with your union. And if you cease to have an obligation under one CBA, but not all of them, then that could trigger a partial withdrawal. That's known as a CBA takeout. Or you could also cease having an obligation to contribute at one or more facilities and like shut down one facility and continue the work at the facility. Or I'm sorry, you don't shut down the facility. You could have you negotiate out at one facility. That's called a facility takeout. And if the key here for both of these is that if you're the work for which you previously had an obligation to contribute, if that's continuing on a non-contributing basis, then you're likely to run into a partial withdrawal. The 70% contribution decline generally occurs over the three-year period, and it's looking at a 3-year. There has to be 3 straight years of a 70% decline from a 5-year testing period. So it could happen, and you could be unaware of it over time, and you have to pay attention to your contributions over time to ensure that you don't drop below that threshold and trigger a partial withdrawal unknowingly. Other things to consider in business planning is control group liability. ERISA treats all, quote, trades or businesses that are under common control as a single employer. They hold them jointly and severally liable for any withdrawal liability. And that could really be something that could ruin your day, because the fund can go after payment from any member of the control group. Courts have held that the businesses that are in a control group don't have to be economically related. They just have to be under common control. And in this regard, I would urge you to watch out for attribution rules, which are common under the IRS, and they're also common under ERISA, that the fund will attribute ownership to various people in relationship to other people that hold ownership interests. For example, a husband and a wife, if their ownership interests can be attributed to one another for purposes of determining whether there's common control. Now, the general principle is that there is no personal liability under in the withdrawal liability scheme under the Multi-Employer Pension Plan Amendments Act. However, that can be skirted through this control group concept, and in a situation like that, withdrawal liability would apply not only to the withdrawn entity itself, but to any trade or business that is within the same umbrella of common control. So this is something to pay attention to when you're thinking of business structure or relationships between businesses or ownership or who holds what in what entities. A trade or a business is they generally, to determine whether something is a trade or a business, the 7th Circuit, where I'm in the Chicago office, and the 7th Circuit Court of Appeals sits here in Chicago, and it covers Wisconsin, Indiana, and Illinois. But a lot of the other circuits also use this test. It's called the Grotzinger test. It's from IRS matter. And they basically look at, to determine whether something's a trade or business, they look at whether the entity engaged in the activity performed for the primary purpose of income or profit and with continuity and regularity. We'll discuss that more in a little bit, but just know it's a pretty relatively easy test to satisfy, although it doesn't include income that you receive as an employee or through other passive investments, hobbies, things like that. I want to note particularly that a trade or business could extend to leasing activity, and this is something that often comes up in a withdrawal liability situation. You'll have a withdrawn employer, and that withdrawn company leases property or equipment to the withdrawn company. For example, there's one case that we'll talk about on the next slide. That's a tugboat company, and the tugboats, or at least some of them, were owned by the owners separately from the company, not through the company, but they leased them to the company. Other arrangements might be where you own the land on which the company sits, or you own the building as well, and maybe you lease the building in your personal capacity. You lease it to the employer, and that could be then considered a trade or business of leasing property, and could put you in a common control situation, so that if the employer that leases that property triggers withdrawal liability, and doesn't have the funds to pay for it, the fund could come after you as a trade or business running a leasing company and leasing property to the withdrawn employer and hold you responsible for the withdrawal liability. In the Seventh Circuit, they refer to that as the leasing property rule. It's also been referred to as a categorical rule. And you'll see some of the cases there that I've cited, including one there at the bottom, this Seahorn Lumber Company, which was just decided a few months ago here by the Northern District of Illinois. The quote from that was, leasing property to a withdrawn employer itself is categorically a trade or business. So that may be the case for some of you here on the webinar today. It's often the case with family-run businesses and that they own land or equipment, or they lease trucks or the building or something to the withdrawn employer. And so you need to factor that in your business planning issues, that the pension funds will view that as falling within the leasing property rule and making you potentially personally liable as part of the quote control group for a withdrawn employer. Another quote here this is from another Northern District of Illinois case in 2014. In sum, if an individual engages in a trade or business under common control with the withdrawing employer by leasing his property to the withdrawing employer, he is personally liable for payment of withdrawal liability. I put that right there at the top in bold because that's a pretty potentially scary statement. Basically, under the leasing property rule, then if an individual owns the property on which a withdrawing employer conducts its operations, leases the property to the withdrawing employer, and owns the withdrawing employer, then the individual may be personally liable for payment of the withdrawal liability of the withdrawing employer. Okay, let's talk a little bit about the controlled group concept then. That's two or more organizations that are trades or businesses, which we just talked about, how you can be a trade or business and be under common control. There's several tests for this that we'll talk about a little bit, but just generally know that if you have other entities, whether they're corporations, partnerships, sole proprietorships, or even something like this leasing property idea, you might want to discuss that with your counsel to determine whether they are part of the controlled group. Common control can be determined through parent subsidiaries, which are generally pretty straightforward, where one company owns another company, usually 100% of a subsidiary. Another idea is brother or sister companies. That's usually 5 or fewer individuals that have an 80% common ownership interest and a 50% identical ownership interest. Again, if you want to get into the weeds on that, please speak with your counsel about it. But just know, where you have a small group of people that are in control jointly of several entities, that can result in common control and primarily results with what you really want to be aware of is that the members of the controlled group are jointly and severally liable, which means that the pension fund could come after any one of them for withdrawal liability in the event that happened. Mergers, stock sales, reorganizations, usually if there's just a change in the company structure through something like that, it's generally going to be okay as long as the obligation to contribute was not impacted. So if you're merging with another company, you're selling the stock of your company, you're just reorganizing the company, changing the structure, etc., that should not trigger a withdrawal and generally does not. However, a sale of assets, which is a very common way to transfer a business, will trigger a withdrawal unless you comply with what's known as Section 4204 of ERISA, which is part of the Multi-Employer Pension Plan Amendments Act. There's a few items that the parties, I's that must be dotted and T's that must be crossed in that instance. And we'll talk about those here. Section 4204. A withdrawal is not triggered despite the fact that you sell your assets if these criteria are met. There's 3 of them that I've listed there. It needs to be a bona fide arm's length transaction with an unrelated party, so you couldn't sell it to your husband or your daughter or something like that. Again, it has to be an unrelated party, must be bona fide, that is genuine, and arm's length. It's not some sweetheart deal that's been arranged between the parties. The purchaser has to take on the obligation to contribute. So in the collective bargaining agreement, the seller has an obligation to contribute to the pension fund. That's the problem. And the purchaser must take on that same obligation. The statute says substantially the same number of contribution base units, meaning if you contribute so much per hour or per shift or per week, that's known as a contribution base unit. The purchaser has to take on that obligation as part of the sale of assets and be obliged thereafter to contribute for substantially the same number of units that the seller contributed for. Substantially the same has generally been held to be 85%. So it's not 100% guaranteed down to the decimal point. It's been determined to be 85% through many arbitration decisions and through litigation under the Act. That obligation is generally determined at the time of the sale. So if later decisions are made or business drops or whatever, and you end up below the 85%, that could still be okay as long as you took on the obligation to contribute for substantially the same number at the time of the sale. And finally, the third criteria is that the seller has to agree as part of the sales contract, meaning it has to be in writing in the sales contract, to be secondarily liable within the first 5 years after the sale if the purchaser incurs withdrawal liability and defaults on it. So a seller can get out of withdrawal liability by passing it on to someone else, but for the first 5 years, they've got to agree to be secondarily liable. Again, if you're looking at something like that, you really want to consult with knowledgeable counsel and figure out what the criteria are and whether you want to meet it or try to do something different. I would note that under Section 4204, the buyer assumes only 5 years of contribution history. Well, as you'll see later on in the presentation, normally withdrawal liability is determined by looking back 10 years. And so it's at least a possibility that the seller's withdrawal liability, if they did not go through the sale, might be higher than the amount that the buyer would take on, because their high years may be more than 5 years in the past. That is, they could be, their highest years of contributions could be from years 6 to 10 preceding the sale. And so it's at least possible that a buyer who takes on the same obligation could be liable for less withdrawal liability than the seller would have otherwise been. That's something to at least ponder. If a buyer is taking a business without explicit assumption under 4204, the buyer should certainly analyze this concept of successorship, which we'll talk about a little bit more on the next slide. You want to make sure that you do your due diligence and take that withdrawal liability into account, even if you're not doing an asset sale under 4204, because you can get stuck with the withdrawal liability even if you try to avoid it. The general rule under corporate matters is that if you're doing an asset purchase, you don't take on the liabilities. That's usually the whole purpose of doing an asset purchase. But here in the withdrawal liability arena, like in a lot of, you'll see, this is just one area of many where things do not go the employer's way generally. And that's true. The general rule that you don't take on the liabilities is out the window often when funds assert that you're a successor and therefore liable for the predecessor's withdrawal liability. So you may go through an asset purchase, not comply with section 4204, which would generally leave the seller liable for withdrawal liability. But if the seller doesn't have the money, which sometimes happens, then the fund will come after the purchaser and say, you are a successor to that seller, and you had notice of the liability, and you're basically running the same business after the purchase as the predecessor ran prior to the purchase. And meeting those two simple factors can leave you on the hook for the withdrawal liability that would have gone to the seller. I listed a couple cases there that show that there are courts that are there are funds that are aggressively pursuing this, and there are courts that are allowing it, and just as showing of notice of the liability and the continuity of operations after the sale. Some of those factors that I've listed there is like if you keep the same people, you keep the same management, you're using the same building or same phone numbers, you have the same name, you're completing work orders that were taken by the seller, the customers are the same. In fact, that resilient floor covering case there that's at the top opined that the customer base was most important factor, which seems a little unfair. That, I mean, if you kept the customers, if the customers stuck around, well, then the Ninth Circuit was suggesting that that was somehow strong evidence of you being a successor, and therefore holding the successor liable for the predecessor's withdrawal liability. And that can be a very unpleasant surprise if you've taken over a new company and feel like you're going on merrily about your business, and all of a sudden the fund shows up and says you owe millions of dollars of withdrawal liability that you did not anticipate. So here's some factors that I've laid out here that courts look at. Again, the physical assets, the equipment, the building, the real estate, the customer base that I mentioned. Other assets, goodwill, trademarks. If you hold yourself out as being the same business, which sometimes happens because the reason you bought the existing business was because of some of these factors, then the courts will say, well, that's evidence that you're a successor. And then they look to see whether you had notice. And in that Heavenly Hana case that was listed on the prior page, the court found that a failure to investigate whether there was pension withdrawal liability and just relying on the representation of the seller that there wasn't was not warranted. And so they said that the purchaser had constructive notice, and they indicated that where the purchaser had a due diligence team, they were purchasing a hotel in that instance, and they said, well, you checked to see, you sent people out there to see whether there was termites and whether the roofs were good and how the structure was. And you did all this due diligence, but you didn't do due diligence on the withdrawal liability. You just accepted this representation. That wasn't reasonable. That reliance on that wasn't reasonable. Therefore, they said you had constructive notice of the withdrawal liability, and they held the purchaser liable for the seller's withdrawal liability, which certainly seemed a little unfair. But that's the way that these things can go under a successorship analysis. So you need to be careful when you're looking at purchasing a company or selling a company that contributes to a multi-employer pension fund. So conduct thorough due diligence on both sides. Watch for the successorship. Make sure you take the liability into account in the sale. There's various ways to do that. You should consult with your counsel about it. Look at the collective bargaining. Even now, this is something where this doesn't just apply just when you're selling or buying. Pay attention to your collective bargaining agreement and make sure that you're contributing in accordance with it. Look and see if there's a participation agreement. Sometimes funds have you sign a participation agreement that's separate from the collective bargaining agreement, and it may have different requirements and different criteria than are under your collective bargaining agreement. You need to be fully aware of that. things that you can check on are whether do you owe pension contributions for vacation or when somebody's on leave? Do you owe contributions for overtime? Or is the work that is being performed within the scope of work that's set forth in the collective bargaining agreement? I've had cases where you come to find out that they've been making contributions that they really didn't owe. And guess what? The pension fund is probably not going to point that out to you. And they may even suggest the opposite, and then use it to your detriment for withdrawal liability too. Does your CBA have a cap on the maximum number of hours? Is it set at 40 or something? Like, you don't have to contribute any more than a maximum of 40 hours in a week or something like that. You should check any limitations in your collective bargaining agreement to make sure that you're making only the contributions that are required and that are in accordance with the written terms of your collective bargaining agreement. Also, when you're negotiating new CBAs with the union, don't just blindly accept whatever they say the rate increases are. It may be the case, and it certainly has been the case in the last 10, 15 years, that the pension funds would show up and say, well, we have a rehabilitation plan and here's the rates. Like there was no negotiations. This was it. It was handed down from on high. And that may be the case, but if you're going to be stuck with that, you need to ensure that in your CBA, there's proper language. And I put under the MPRA, that's the Multi-Employer Pension Reform Act. And I'll talk a little bit more about that here in a minute. But basically just note this, that if you had an increase imposed on you by a fund through a rehabilitation plan or through a funding improvement plan because the fund was in critical status or endangered status or critical and declining status, you might agree to those increases because you have to as part of the rehabilitation plan, and you decide you're not getting out of the fund. But those contribution rates should not be used against you to later calculate withdrawal liability. And we'll discuss that in some detail later, but it might be a good idea that if you agree to those rates, put some language in the CBA that says, these rates and increases are the rates that were required under the rehabilitation plan and nothing more, something like that. Just so that there's no question about it later. Also, pay attention to evergreen clauses. We'll talk about this a little bit more later as well. But if you're going to negotiate out and you have the idea that you're going to negotiate out of an agreement, or even if you don't, there's usually a term commitment at the end of the CBA. It's usually like the last article, and it'll say this CBA is effective from X date through Y date. And you have to give notice, more than 60 days prior to Y date, or else it will renew year over year. And that could happen. If you're thinking of like, I might want to get out of my pension fund, you need to make sure that you dot your I's and cross your T's as far as giving notice properly to the union under the CBA. Otherwise, the pension fund could show up later on and argue that it renewed, and now instead of getting out, you're in that fund for another year. And like I said, we'll talk about that for a little bit more detail later. Pay attention to the control group, as we discussed, particularly leased property or equipment. And then pay attention to these audits because, again, if you're making contributions that are not in accordance with the collective bargaining agreement, oftentimes the pension fund is not going to point that out, or they're going to feel otherwise. They're going to feel that it is, you do owe those contributions. And so when they come to audit, make sure that they're looking at the right things and that you're paying attention to what they're looking at and the determinations that they're making. Because if they hold you responsible for greater contributions, that's probably going to come back and bite you if you ever were to withdraw, because that will increase your withdrawal liability as well. Well, how do you know any of this and what do you do about it? Well, you can ask for an estimate, an information request. You can do that every year. They're annual. You can ask for financial and valuation reports. I have a sample sort of template that you can use that we can talk a little bit about, but I think it's a good practice for anybody that contributes to a pension fund to send in an estimate and ask for, hey, what's my withdrawal liability? You can do that annually. The fund is also supposed to send out funding notices declaring what their funding status is. You need to check on what their investment returns and assumptions are. And you can also ask them for arbitration decisions. under ERISA 101L, you can request all this information. And like I said, I have a template that I'm happy to share with you if you want, that you can just cut and paste and put on your own letterhead or whatever and send in annually to request a lot of these items from your pension fund. But mostly what you really want is the estimated amount of withdrawal liability. And under the statute, I've listed some of the specific items that you can request there, how the liability was determined, the actuarial assumptions and methods that were used to determine the value of the plan liabilities and assets, data on employer contributions, UVBs, and the annual changes. And then the key there is application of any limitations, meaning like the 20-year payment cap that we'll discuss here in a little bit too. But the pension funds often will pretend that your withdrawal liability is actually the unfunded vested benefits. They won't apply any of those limitations, and they'll send you a letter back that says, well, here's your withdrawal liability if you were to withdraw, this year, and it's, $10 million or $20 million. Well, given how underfunded these pension plans were for so long, that number may very well be, and often is, in my experience, it's not your actual withdrawal liability that you would actually pay after those limitations. It's the unfunded vested benefits prior to the limitations. And so you really need to pay attention to that, because I think over the years, they've probably scared a lot of companies into staying in the funds thinking, well, there's no way we could get out by throwing these inflated numbers at them and these inflated amounts. But that's not actually been the withdrawal liability that would actually be payable if you withdrew. So pay attention to that too, and you should definitely request the withdrawal liability. Let's go on to minimizing withdrawal liability. What are some things you can do here to minimize it? Like I said, you calculate the withdrawal liability by first allocating a portion of the unfunded vested benefits. So the vested benefits are the amount that's promised in the future, and it's, sky high, and they're going to owe X dollars to these participants. And the amount of money they have is below that. They've got a lot less money. Well, that delta there, the difference, is the unfunded portion of the vested benefits. They allocate a portion of that. And upon a withdrawal, the fund says, okay, well, here's all the unfunded vested benefits. You contributed to the fund, this much over the last years. Here's your portion, which is generally proportionate to your historical contributions, and they allocate that portion to you. Then that amount is adjusted downward by 4 potential adjustments, including a de minimis. And you're in trouble when you're talking about de minimis amounts, and it's usually $100,000 to $150,000 is counted as de minimis. That doesn't even matter. Well, that shows you how high withdrawal liability often is, and it's a lot. Then the 20-year payment cap, the statute requires that the fund assess withdrawal liability through annual payments, and those annual payments are limited by a couple factors that we'll talk about here in a little bit. Remember too, and we'll come back to this, but the unfunded vested benefits, the way that those are calculated is by actuaries who look at a lot of different factors, such as like the date of the withdrawal, the date that the assets and the liabilities are valued. They make different assumptions on mortality and the method, the allocation method that's going to be used by the plan. They make all these assumptions, and then they apply different interest rates to those too, to get to based on these assumptions. And employers have been increasingly challenging those interest rates that they use to value the unfunded vested benefits. And there's 3 cases that we'll discuss briefly later on where employers have prevailed in challenging those interest rates. So be aware of that. These relief provisions, the deductions from the unfunded vested benefits, include all of these provisions here on this slide. The de minimis I've already mentioned. The 20-year payment cap, which is again the annual payment. They can only make you pay a set annual payment that's determined by a formula under the statute. They can only make you pay that for 20 years. And in my experience in the last 10, 15 years, there's been a lot, most assessments of withdrawal liability, in fact, come out less than the allocable amount of unfunded vested benefits, due to the fact that the fund is limited to collecting 20 years of that set annual installment payment. The bottom two here, the sale of assets limitation and the insolvency limitation, are both found in ERISA section 4225, which can be something that a lot of employers need to pay attention to, even if they're shutting down and going out of business. I've seen instances where employers just shut down and think, well, I don't have any money, I don't have anything for the fund to come get. They forget about a control group issue, and they forget that they may have leased property or some of these other issues, and they just let the fund do what they want. Well, guess what? Had they gone out of business and sold everything through this sale of assets limitation, they may very well have limited the amount of unfunded vested benefits that can be allocated, and it could severely and drastically limit and lower the amount that could ever be applied as withdrawal liability. So it may be worth checking into that, even if you think you're just shutting down and going out of business and not even selling. You could sell your assets at an auction, for example, and still apply the sale of assets limitation. The insolvency limitation is declaring bankruptcy. Again, that's another limitation that's in the same section of the Act, and it limits the amount of unfunded vested benefits that can be allocated to a withdrawn employer. I discussed this a little bit more here on this slide, but it can be substantial savings. And again, if you end up even with a entity that doesn't have any money left at the end of the day, it might be very important to limit the withdrawal liability if you're in a control group situation and the fund may be seeking money from other sources, other entities. Something else to be aware of is this prior partial credit. If you've had a prior partial withdrawal, then the statute specifically states that the amount of withdrawal liability in a subsequent plan year shall be reduced by the amount of any partial withdrawal liability for a previous plan year. Well, there's some fights going on about this and how this is applied, but it could be substantial savings. And just know that if you've had a partial withdrawal in a prior year, you definitely should be getting a credit for that amount against any later withdrawal. And that can happen. You can trigger partial withdrawals without even knowing it until there's a complete withdrawal. Or you might have a whole series of partial withdrawals that come your way. Before you're even given notice of one of them, you may have two or three, because remember I said the partial withdrawals can be determined by a 70% decline over 3 plan years. Well, it happens quite regularly, as a matter of fact, that employers can trigger more than one partial withdrawal. They can have successive partial withdrawals and not even be aware of them until the fund shows up years later and says, oh, by the way, you had a partial withdrawal this year, the next year, and the year after that, and you owe us for all 3 of them. And in that instance, there are funds out there, and you can see from the case that's cited here in the middle of the slide that are in my view, not applying the proper credit, or not giving proper credit for the prior partial withdrawals. There is a Pension Benefit Guarantee Corporation opinion letter that I've put in bold there, 85-4, that spells out what I believe to be the correct method, and the PBGC said that it was the method of applying the credit was correct, and that the method that was adopted by the Ninth Circuit here in this 2018 case was clearly erroneous. Well, there's a case pending in the 11th Circuit right now where that issue is coming up again, and there's a couple more that I'm aware of that are pending in the district court. So if you have any kind of a credit issue, I urge you to talk with counsel, because all may not be lost. That Ninth Circuit opinion, in my view, is exactly what the PBGC said, clearly erroneous. So be aware of that. Another way to minimize withdrawal liability is paying attention to the timing of withdrawal liability. It can make a huge difference, because if you look at that upper right square there, under ERISA, the date of a complete withdrawal is the date of the cessation of the obligation to contribute. Well, oftentimes, as you're probably aware, your collective bargaining agreement goes through, like December 31st or to January 1st or something. And so if it's commensurate with a plan year, plans can set their own year, and they're often calendar year, but sometimes it's July 1 through June 30th or something. You need to know what the plan year is and what your date of withdrawal might be when your obligation ceases, because it can make a huge difference, because withdrawal liability is calculated year over year. I had one situation one time where a pension fund actually kicked out my client, and they kicked him out on, they said effective on January 1st. Well, guess what? The plan year ended on December 31st. And so we had a fight about, what year we were kicked out. And that, I believe they tried to keep us in to the end of the year so that they could get all the contributions for the whole year, but then still kick us out and nail us with the withdrawal liability, which would have been advantageous to them to kick us out that same year. But they worded it wrong, or they screwed it up somehow, because they said, effective January 1st or something like that. And so we argued that it wasn't until the next plan year, and that one day made all the difference, and it ended up being a very large difference. And so it's very much worth it to pay attention to the timing. Check the fund rules. A lot of funds are having rules in their trust agreements and pension plan documents now that talk about you have to contribute through the entire term of the collective bargaining agreement, or after the CBA expires and while you're still negotiating. And here's where we talk about these evergreen clauses again that I mentioned earlier. This is specific with regards to timing. There's a recent case here in the Seventh Circuit. Again, this came out just over not even a year and a half ago at the end of 2022. Central States versus Trans-Service Logistics. In this case, Central States has a trust agreement, and it says the employer is obliged to contribute for the entire term of the collective bargaining agreement, including any extension through an evergreen clause. The evergreen clause, remember, is the portion that says when the CBA was going to terminate, and it said something like the CBA will terminate as of January 31st, 2019. Unless neither party gives notice more than 60 days prior of an intent to terminate. And the union sent its negotiation letters, which hardly anybody pays attention to oftentimes, and they just take it as pro forma. Well, the union sent these negotiation letters in November 2018 saying, we want to negotiate a new agreement, and blah, blah, blah. And they sent it in. Well, the employer wanted to get out of the pension fund, but they relied on those union letters. And the union, the term clause said that you had to get a notice of intention to terminate. Well, they actually met with the union. They sat down, they negotiated a new agreement. They ended their obligation to contribute to the fund, and they put in that they were going to contribute to a new fund. And that was fine with the union. But then the pension fund, the original pension fund, Central States, showed up and said, hey, you guys still owe us contributions. And the employer said, no, we don't. We negotiated out. And the fund said, well, that's nice, but we believe that your agreement renewed through this evergreen clause for another 12 months because nobody gave notice of an intention to terminate the agreement. And so they sent them the letters from the union, but the letters from the union only said something like, we would like to negotiate a new deal. And the district court ruled for the employer, but the Seventh Circuit reversed and said, threw that quote in there so you can see, when an evergreen clause provides that termination will occur upon timely notice of intention to terminate, anything short of a clear expression of such intent, that is an intention to terminate, fails to qualify as an effective termination notice. So guess what? The employer, and it was two employers actually with the same set of facts and circumstances, one of them got stuck with another $2.6 million of contributions, and the other one had like $9 million of contributions. So it's a huge deal. And I believe, I don't know, but I suspect that mattered for their withdrawal liability as well, because it meant that they were in the fund for another year. So again, the timing can make all the difference for a couple of reasons, and it could be the nastiest of surprises when you find out too late that the agreement, as far as the pension fund was concerned, was not actually terminated. So how do you how do you determine what your payment is going to be? Remember, I said there's a 20-year cap, and they can only make you pay an annual payment for a maximum of 20 years. You look at your contribution base units, which, as I said, were if you contribute hours or shifts or per week or whatever it is, whatever it says in your CBA. You look back 10 years, not including the current year. You look back the prior 10 years for what your contribution base units have been. So, the number of hours for which you contributed each year over the last 10 years. Then the other factor is your contribution rate for the last 10 years. This includes the current year. And the reason why is because your current year is probably your highest contribution rate. And so you get those two factors, and your annual payment is the contribution base units, number one, times the contribution rate, number two. Your highest years out of the last 10 years. It has to be 3 consecutive years out of those 10 years, and they have to be consecutive. Pay attention to that. You look at your highest contribution base units, add up those 3 years, then divide it by 3. That's your highest contribution base unit years, and you multiply that by your highest contribution rate. That's your annual payment. The last square, there's the 20-year cap. The fund can only make you pay that annual installment payment for no more than 20 years. If you pay it off in 10 years, great. That's, you can, if it's 10 annual payments, fantastic. But the funds have been so underfunded for so long, that's not usually the case. So the 20-year cap comes into play, and they can only make you pay that annual payment for 20 years. You should also be present value. If you're going to pay it as a lump sum, you have a right to prepay it, and you can argue about what the discount rate is if the fund tries to stick it to you on that. This is an important point to consider with regards to the prior slide. Under that MPRA, the Multi-Employer Pension Reform Act, any increases in the contribution rate that were required or made in order to enable the plan to meet the requirement of its funding improvement plan or rehabilitation plan. So again, if your fund is in critical or declining status or endangered or whatever, they have to, by law, have a funding improvement plan, or more likely a rehabilitation plan. And if you agreed to those increases in contribution rates just because you had to, because that was required to meet the rehabilitation plan, those increases are disregarded in determining the allocation of the unfunded vested benefits and the highest contribution rate. So in calculating withdrawal liability, that could be a huge difference, because the increases after December 31st of 2014 should not count against you for purposes of calculating that annual payment. So it might be a pretty good deal. This has been getting fought out. There's been a bunch of arbitrations, maybe even up to 10 or 11 different arbitrations on it now. The funds have actually lost most of these, and there's been several appeals going on in district courts, and we should start seeing some opinions pretty soon. But I feel pretty confident that the Multi-Employer Pension Reform Act was the language clearly excludes these contribution increases from being factored into the calculation of withdrawal liability. So pay attention to that. I know we're at 1 o'clock, but I'll just try to get through the rest of this real quick since we started a little late. I really apologize for that. Know that if there are successive partial withdrawals, again, you should look for the credit, and pay attention to this, because this has actually come up in at least one case. You can't have a partial withdrawal after a complete. So remember I said that you can have a partial withdrawal if you have a 70% decline for 3 years in a row. Well, this GCIU fund down in California actually applied a partial withdrawal to an employer, maybe even 1 or 2. Then the employer completely withdrew, but the 70% decline continued after the complete because it was still 0. Well, the fund assessed 2 more partial withdrawals after the complete, saying, those 2 years were zeros. That's factored into that 3-year period to determine a partial withdrawal. So you actually had 2 more partial withdrawals. And even the Ninth Circuit didn't buy that. And the Ninth Circuit said, no, you can't have a partial withdrawal after you've had a complete withdrawal. Complete means everything, and there is no partial left. So that was one bright spot for employers there. Let's talk just briefly about fighting withdrawal liability. basically you have to arbitrate. If you don't arbitrate, then you may lose any defenses that you had against an assessment. Any dispute between an employer and the plan sponsor shall be resolved through arbitration. That's quoting from the statute. So pay attention to, if you ever get a notice from a pension fund saying you owe them money, you need to pay attention to it right away. Here's the procedural timeline. When you get the assessment, you have to start making interim payments under this pay now, dispute later rule that is applied to withdrawal liability. You have to start making payments no later than 60 days, and even continue making those payments while you're challenging the withdrawal liability. You file what's known as a request for review with the fund within 90 days from your receipt of the assessment, and then you can initiate arbitration within 60 days after the fund's response to your request for review, or if they don't respond, 120 days after the request for review. Now, the statute also has a provision that allows the parties to jointly initiate withdrawal liability within 180 days after the assessment. Probably a better practice to request review so that you preserve that right unequivocally to initiate arbitration. But there is at least an argument that you could initiate within 180 days. Better to request review. The pay now, dispute later, I mentioned briefly, you have to make those payments. And if you go into default, the pension fund can accelerate the entire amount of the withdrawal liability. Pay attention to this, because sometimes the funds will try to argue that the acceleration is more than just an acceleration. Remember, I said it needs to be installment payments. So the statute is designed to pay out over, up to 20 years of these installment payments. If you default and you fail to cure it, then the pension fund can accelerate the entire amount that would otherwise be due. But what these pension funds have done in various circumstances is they said, well, in a default situation, we can recover the full amount, meaning the allocable amount of unfunded vested benefits, not the withdrawal liability. I think that's blatantly wrong. I think it's blatantly taking advantage under the statute, but just know that they try to do it. So you need to pay attention anytime you get an assessment, and particularly when you get a notice of default, because they may try to stick it to you unfairly, I think, but they may try to do more than accelerate. They may try to increase. You may have to use the AAA. I won't talk too much about that. That was another issue that even the AAA was gouging employers, but that's been stopped. And then pay attention to these interest rates. Remember, I said earlier that there are several circuit court cases here in the last couple of years, and you can see 2021 and then 2 of them in 2022. So you got the 6th Circuit, the DC Circuit, and the 9th Circuit, all struck down what was generally known as the Seagal blend. And it was these actuarial interest assumptions that they were using, where they were using different rates to determine the withdrawal liability than they were to determine their own funding rates. And employers challenged that, and in all 3 cases, they prevailed. So that's another fruitful avenue to litigate if you end up in one of these situations. Another decision was this Metz Culinary Management. That an employer challenged the calculation of withdrawal liability and the actuary's use of assumptions that were adopted after the last day of the preceding plan year, meaning after the date of the withdrawal. And the 2nd Circuit said that the actuary could not properly use rates that were adopted after the withdrawal. So pay attention to that. Finally, I'll mention this American Rescue Plan Act on these last couple slides. Just after President Biden was elected in March of 2021, they passed this American Rescue Plan Act. A lot of people were unaware, but there was, close to $100 billion, just sort of a blank check written to multi-employer pension plans to pay for the accrued benefits for these union retirees through 2051. So through up to 2051, 30 years from when it was enacted, these funds could just apply to get money to pay all those unfunded vested benefits for these union members' retirements. They had to reinstate any benefits that were cut previously or any suspended benefits. So it got jacked up and then put the bill on the American Treasury with no obligation to repay these funds. So the Pension Benefit Guaranty Corporation was charged with enacting this, and they came up with this special financial assistance program, which would establish the process to apply for these funds. Lots of funds have been getting money. Many are still out there waiting, but they're going to get money too. In central states, who it's come up a couple times here in our presentation, for example, got almost 36 billion. I think they got a check written from the American taxpayer for $35.8 billion. So you would think, as the employer, well, then that ought to get rid of all the unfunded vested benefits. That's the entire stated purpose. So that ought to get rid of withdrawal liability. Well, maybe not. The House version of the act included a provision that said an employer's withdrawal liability shall be calculated without taking into account special financial assistance received under this section until 15 calendar years after the effective date. So the House then in 2021 was trying to get it where it wouldn't count for employers who incurred withdrawal liability until 15 years later. While the Senate parliamentarians said that couldn't be included in the bill because it was passed under reconciliation. So they changed it, and the final act authorized the Pension Benefit Guaranty Corporation to impose what it called reasonable conditions relating to reductions in employer contribution rates and, quote, withdrawal liability. So lo and behold, the PBGC has now come out with a regulation that phases in these special financial assistance funds in the calculation of withdrawal liability to the detriment of employers. So that money is there, but when an employer withdraws, you have to pretend that some portion of it at least is not. And so there can still be significant withdrawal liability. Well, there's a case that I'll mention here, and then this will be the end. This In Re Yellow Corporation is a bankruptcy case pending in the District of Delaware. And the fund, which was Central States, which remember just got $36 billion, had told the PBGC as part of its application to get the 36 billion that it was only going to receive de minimis amounts, if anything, from Yellow Corporation if Yellow went bankrupt. Well, Yellow did go bankrupt. And instead of filing a claim in the bankruptcy court for de minimis amounts, they filed a claim for $6 billion and said, we're entitled to all this so-called withdrawal liability. The debtors then filed an argument with the bankruptcy court saying that the Pension Benefit Guaranty Corporation regulation cannot change the statutory definition of unfunded vested benefits, which means the non-forfeitable value or the value of the non-forfeitable benefits under the plan over the assets of the plan. And that's an interesting argument. I mean, I think it's a straightforward argument, and it's pretty clear that regulations can't override the statute actually passed by Congress. And for $6 billion, that's going to be a pretty hefty fight, and it'll be interesting to see how that plays out. But it's something that you should keep your eye on if you feel like you may have some withdrawal liability at some point in the future. That's it for my presentation. I appreciate you being on here. I appreciate you sticking around even through the technical glitches. I greatly apologize for that. I don't know what the situation was, but if anybody has any questions, I'm happy to stick around and answer them. But thank you very much for your time.